welcome to the weekly market view. I'm back here with Bill this week. So obviously I think the highlight of this week has been Carney and the Bank of England making a statement yesterday at his press conference. We saw him put that unemployment threshold in of around 7%, but did put his forecast for that, or the Bank of England's forecast for that, was quite a way off, around 3 years. What did you make of it, and what do we see in the markets as a reaction?
I guess my initial reaction was what I saw in cable when it dropped to like 152, the figure. Then all of a sudden it went from like 152 to 155 and a half, but everybody got very constructive on it. Yeah. Well, I don't know. I guess I look at the economy differently now living in the country, okay, rather than living in London, everybody working in the city and driving Bentleys and this, that, and the other. I mean, I look at people who are struggling, not to pay school fees, a huge mortgage, but just the basics. And also the simple fact is, if we look at a 7% unemployment rate based on the number of people, the economy, again, this is what I figured, but one of the think tanks came out. It does mean we would have lost like 425,000 jobs since 2008. So the economy, so the unemployment rate is going down, but where are the jobs going? And we saw this, in last week's U.S. non-farm payrolls, when we did see the unemployment rate drop to 7.4. But the reason for that was the number of people like myself, old age pensioners, retirees, who finally said enough is enough, and they, quote, got out of the employment picture. So therefore, you saw the rate drop, but these are people that are out of the picture. And I think one of the things that we see, and maybe this goes back to, maybe some of our viewers have not seen this, these zero, paid contracts, well over like 1 million people. Well, to me, it's the same type of people that, were IT gurus or were bankers or this, that, and the other, laid off for whatever reason, where I would call them like kitchen industries. 3, 4, 5 people to get together and say, maybe we start our own company and use our skills. Well, they're not making any money, but they're not still classified as being, quote, unemployed.
Yeah. So do you think, obviously the central banks are putting the Fed and now Carney's put the threshold at the headline rate. So how do you think you would trade this, even though it may not be a true picture of the health in the unemployment market, into the fact that people have left the employment picture? Well, how would you trade it? Because if we have to look at that headline number, is that what you...
Well, I guess I'm not the person you should be talking to, because, I mean, I was short cable at 150, 350. My feeling it should be going to 148 rather than 158.
Okay. And
also the simple fact is, even with the euro, I mean, we were effectively feeling that 132.70 and 133 was a positive short. And as we saw this morning from the European Central Bank, albeit 2 or 3 months late, they've come down and downgraded growth. So I guess the feeling I've got is, we got some decent numbers out of China, but the simple fact is the U.S. economy is sputtering. We've gone back from tapering being a done deal on the 17th and 18th of September, now possibly to the 18th of December FOMC meeting, and maybe even into 2014. And then here we have in the UK, like, hey, wonderful sunshine. But even then, if you looked at his body language and looked at some of the hesitation when he was talking about it, especially in the Q&A, we're still talking about, as he said, wait a minute. The sun is out, but there's still a few gray clouds on the horizon. And you're talking about, inflation. Well, I think inflation will continue to drop, but even then at 2.5%. I mean, real wages, okay? This month, or the last month, 2.9% was the inflation rate. The real wages is only 1%. It's been 45 years in the UK since we had this wide spread between wages, real wages, and inflation.
Do you think we'll see then a correction in the markets if as you said, you think cable is probably slightly too high and you were forecasting it lower? Do you think we'll see that correction coming back?
Well, I think one thing we did see yesterday, for me, the reality was, look how the stock market was off almost 1.5%, okay? And it wasn't the mining shares and the et cetera, et cetera, et cetera. But look at some of the stock with the retail sector, okay? Are we going to have that much excess cash? Now, one of the things that you probably may help is a simple fact is, if you're on a mortgage, whether it be a fixed rate or whether it be a flexi rate or tracker or whatever, you at least now can go, whew, I've got breathing space for at least the first quarter of 2016. But does that mean now that money that you were putting aside to start paying off the mortgage, that means put it off for another year, another 2 years. Does that mean then you're going to buy the new Bentley or the new this and your champagne and your caviar, etc.? So I don't think so. I think the UK consumer is still going to be very much concerned about looking over, what happens to get down to that 7%. And yet, you had people yesterday that all this, the BBC and Sky, they were talking to this company and that company. They said, oh, so it's going to be great, because the fact is, we know our rates aren't going to go up and this is not going to go up, and so therefore we can start thinking about taking on more workers. Well, talk's cheap. Let's see if we start seeing this dramatic fall in the unemployment rate.
Do you think we will see it take 3 years, or do you think he obviously put 3 clauses in that would make that void the 7% threshold?
Well,
do you think we may, you mentioned inflation, that you think it will come down, so you don't think that he'll make it void in that sense, or he also mentioned financial instability in terms of possible bubbles, and there's talk about housing bubbles.
Well, let's go back to what you just said about the bubble, right? All right, first of all, if you know that interest rates are not going to go up until the first quarter of 2016, say you've been saving for that house, maybe now you're willing to gamble a little bit more. And believe me, people now have been taking down fixed rate mortgages, okay? We've seen, I know London is not the right place, but I mean, we've seen like 10% growth in some places in London. But we're all starting to see growth now in places like Newcastle, things like that you would have seen before. So therefore, are you then going to start seeing people, I think I will buy that house?
Yeah.
I know it's very difficult here in London because prices are so high, but I mean, I do see a situation where there is the potential. This is the same place we were before, but you see, I guess I'm going to show my age now. We're talking well before Mr. Greenspan said you take away the punch bowl before the party gets started. He basically made a comment about 2 years before that, when some young Wall Street Journal reporter was asking him a question about Mr. Greenspan. What about interest rates? He said, basically, the market tells us what the correct level for interest. We just react to it, okay? And again, as we were seeing, I mean, what did you see, in the short sterling strips yesterday? I mean, they were applying like, maybe middle of 2015.
Yeah, we saw some quite unusual moves initially, sort of going bid on the comments on the headlines, and then people seem to digest the comments and then factor in possible rate hikes as early as 2015, which seemed very unusual. So
yes.
It'll be interesting to see how it plays out.
I mean, when the governor's telling us first quarter of 2016, probably at the earliest, and then the trader said, wait a minute, I think I'm going to buy, mid-2015 levels. So, it really is, it's almost like confused.com. I mean, I haven't seen the FTSE today, but the simple fact is we all both know that it's some.
Yeah.
So you've got one buyer and one seller that is totally going to distort the market. But I mean, it's a situation where I think, fortunately, the market does and always will forget the rhetoric and deal with reality, okay? Now, it may take till the kids go back to school in September, but, I thought the move down to 152 in the early part of yesterday's announcement, Mr. Carney, was the correct level, not 155. And then you go back to what the IMF said, about 2.5 weeks ago, that the simple fact is that, and this is when sterling was struggling with 150, he said the currency is 12 to 15% overvalued. And all of a sudden, if it's overvalued then, looking at where it is now, and also looking at where our trade deficit is, okay? We're not, if we can't sell stuff at 150, we're not going to sell stuff at 155.
And you've touched on the non-farm numbers and sort of the strange figures that we saw last week and the rate coming down. We've also seen from the US, and across Europe and the UK as well, that the US 10-year yield has been slowly climbing up for like the last 3 months, and we're sort of seeing levels that we saw around 2011. What do you see as the effect of these yields creeping up? Do you think it's going to be something the Fed are going to be watching out for?
Have to. If you've seen, I think it was Bullard last week, right? One of the things he was talking about is, yes, we've seen, remember, just since May, we've seen the Treasury 10-year go from 161 to 275. Well, remember, in the US, the 10-year, because probably at least 3/4 of US mortgages are fixed rate based on the Treasury 10-year. So you see mortgage rates go up 100 basis points right now. Well, that's not a lot from the base we're starting from. But the simple fact is, if you're counting your pennies and all of a sudden, okay, I was basing it on a rate back in May rather than the 1st of August. So I think the same thing will happen here. But my feeling is, if you believe in what the Fed's going to do, the Treasury 10-year, to me, it should be 2.25, 2.35, rather than 2.75 to 3%. And I mean, you see that in the short end of the curve right now. Forget the 2s or the 3s, but the 10s and the 20s, 10s and the 30s especially, are so much more mortgage related in the States than they are over here. And I mean, should the gilt still be trading 10, 12 basis points lower than the Treasury 10-year? Again, it's one of these things where this is a new ballgame. If this is how the level should be.
Also, you've touched on the tapering as well. What do you sort of see happening when we do start to see the tapering in terms of globally, particularly possibly in Europe, where we're starting to see figures come in slightly better in Europe. We're slowly seeing improvement, but still not great data. But if we're slowly seeing a recovery there, and obviously the US is a step ahead, and they do begin to taper, do you see this having knock-on negative effects for Europe, and do you maybe see that as, do you think they'll need to undertake another LTRO?
I don't know. It's one of these things where, first of all, when interest rates go up too high, we know they're going to go down. When they go down too low, we know they're going to go back up. It's just a question, and you're probably involved with this, okay? Or for me, I mean, I've never seen interest rates. I've never seen an FOMC decision, remember, what? I mean, normally, and I was talking about this some week, okay, in reference to like the beige book. Now remember, in the 12 Federal Reserve districts, in the old days, when we used to adjust rates up or down, each district then had their own rate, okay? You'd have the national, the Fed funds rate. But then if you lived in Cleveland and the market wasn't very good, maybe you'd lower the rate. If you're in San Francisco, we were having the dot-com boom, you could raise the rate. I mean, now, nobody even sees this, okay? For the simple fact is, it's a general rate and rates are just low. Now, we always knew whenever something like the quantitative easing started, it was going to stop. But the simple fact is, one of the things that will probably help the U.S., even when it stops, because of the current account situation. Okay, we saw the trade numbers earlier this week. They were phenomenal, okay? Now, because of that, and also the simple fact is the U.S. now is saving more, and they're not spending as much. So therefore, the Treasury now has already started to reduce the auction sizes. So therefore, anybody looking to buy bonds, there are going to be fewer bonds to buy. Now, one of the things is we're all concerned about is, first of all, we had the fiscal cliff. Well, that came, and then we had sequester, and now everybody's saying, well, will the politicians not pass the debt extension? Well, I mean, we may be reaching a point where they got to, okay? For the simple fact is, if we are looking for any type of global recovery, the U.S. can't say, well, we'll sail. What about Washington, D.C. or something?
We've seen stocks reaching highs again last week. We're always hearing that in the news, reaching highs, it's been going to highs. Is this alongside the excess liquidity we've seen with the tapering? So when they do, or with the QE, so when they start to taper, what do you see happening in terms of the stocks? Do you think they will start to come off?
No, I don't think they will, because what you've seen is a massive evacuation, if you can use that term, from bond funds. Interest rates, even if the 10-year went from 162 to 2.75, you didn't see people rushing back into bond funds. You saw them going into the S&P or the NASDAQ or global equities. And you see, this is where maybe yesterday, when we were talking about interest rates staying at this level here in the UK to 2016, how come we saw, a 1.5% sell-off in the FTSE, okay? Because if you know, and you've had money in your local savings bank rather than your Wanga account, then why didn't you pile it into stocks yesterday? Figure interest rates are going to be at this level for another 3 years. So you know you're not getting anything on your savings. So therefore, where you start seeing money going out of, quote, savings account. But then again, you see, this may be the demographics. You see, I mean, if you're an 80-year-old pensioner, you're not looking for, a 20-year return on a stock. You're looking for, safe. I want to be able to make sure that come winter, I can pay my heating bill or my light bill, etc., etc. So I see, no matter what happens, I see a continuation in the stock market. I think what I found healthy, is the stocks up until the last maybe 2 years that were leading all of the indices, were the Fresnillos, were the BPs, were the mining stocks, the Rio Tintos, etc. Well, they're the ones that have been hit hard. Okay, people. I mean, those were just the easy trades. I mean, I think for like 5 years, you know, like what you had 8 stocks in the FTSE that was 70% of the growth. All right. Well, now those 8 stocks, you know, they're at the bottom of the return, and so you're starting to see going into stuff like Tesco's or Thomas Cook, right? Who would have looked at, you know, at a travel agency? What, 2 years? It was trading like 14p, now like £1.60. So you're starting to see ITs, you're starting to see medical stocks, you're starting to see good stocks with basic industries that people understand. Okay,
Yeah.
so yeah, I see a continuation in the stock market.
Do you see a comeback for those commodities that have sort of fallen, you know, the commodity stocks, the prisoners, and that have fallen down? Do you see a comeback for them, or do you think it's just changed the relationship of how people
I think what we have is we're having a slow evaluation or an evolution into the new regime. Do I see gold coming back to 1900? No, but I don't see it going down to 1,000, because you're still going to have central banks buying. It's going to reach a point, and I don't know what that point is, you know, for copper or iron ore or this, that, or the other, where all of a sudden then it becomes profitable again. And I think one of the things that you're all looking at is a lot of these companies, this is unfortunate, in the countries that cannot afford it, are to lay people off. Mm-hmm. You know, because we saw the same thing in this country 25 years ago. Coal. What's coal? It's coal. Is that something we have in the winter? So, you know, we have, I think our only working coal mine in the UK is for tourists. Mm-hmm. So, you know, where you see that evolution. But then whether we start seeing iron ore, you know, I should probably be saying this, I'm very pro-fracking, okay? You know, but yet, does that mean then you're going to have, does that mean, you know, the oil companies as we know them, you know, will maybe disappear?
Good. All right, well, thanks for that, Bill.
Pleasure.
And we'll see you next week.